There are over 10,000 hedge funds in the world, thousands of the smartest people alive, MBAs from Harvard, PhDs in mathematics, people who do nothing but study the market 80 hours a week. And yet, the majority of them, over any 15-year period, cannot beat a simple index fund that requires zero skill, zero research, and charges almost no fees. Today we're going to talk about why that is. We're going to break down exactly what the S&P 500 is, how it works, and why it might be the most powerful and most boring wealth-building tool ever created. Let's get into it. Okay, so first things first, what actually is the S&P 500? The name stands for Standard & Poor's 500, which sounds way more complicated than it actually is. The S&P 500 is simply a list of 500 of the largest publicly traded companies in the United States. We're talking Apple, Microsoft, Amazon, Google, JP Morgan, basically the backbone of the American economy, all in one place. Think of it like a scoreboard. When people on the news say the market was up today or stocks are crashing, 9 times out of 10 they're talking about the S&P 500. It's the benchmark, the thing everyone measures everything else against. These 500 companies are spread across every major sector of the economy: technology, healthcare, finance, energy, consumer goods. So when you invest in the S&P 500, you're not betting on one company or one industry, you're betting on the entire US economy. And historically, that's been a pretty good bet. Here's where it gets interesting. Since 1928, the S&P 500 has returned an average of about 10% per year. Now there are years where it drops, sometimes a lot, but zoom out and the line always goes up. If someone had put $1,000 into an S&P 500 index fund in 1990 and just left it alone, no checking it every day, no panic selling, nothing, it would be worth roughly $22,000 today. That's with zero effort, zero skill, just patience. That number is the reason Warren Buffett, literally one of the greatest investors of all time, has repeatedly told regular people that an S&P 500 index fund is probably the best investment most people will ever make. If Warren Buffett is saying, don't try to be Warren Buffett, maybe we should listen. Okay, so how do you actually invest in the S&P 500? Because you can't just buy the index itself, it's a list, not a stock. What you buy is called an index fund, or an ETF, an exchange-traded fund that tracks the S&P 500. The most popular ones are VOO from Vanguard, SPY from State Street, and IW from BlackRock. They all basically do the same thing. They buy a tiny piece of every company in the S&P 500, so when you buy one share of VOO, you instantly own a sliver of all 500 companies. Now here's something most people don't know. The S&P 500 is weighted by market cap. That means bigger companies take up a bigger percentage of the index. Right now, Apple, Microsoft, Nvidia, and a handful of tech giants make up a huge chunk of the whole thing. So when Apple has a great quarter, the whole index feels it. And the fees on these index funds? Almost nothing. VOO charges 0.03% per year. That's 3 cents for every $100 you have invested. Compare that to a hedge fund, which might charge 2% annually plus 20% of any profits they make. That fee difference alone is enormous over decades. Okay, here's the part I really want you to understand. Why can't the smartest people in finance consistently beat this index? It seems like it should be easy, right? These people do this for a living. The answer comes down to something called efficient market hypothesis. The idea is that stock prices at any given moment already reflect all publicly available information. Every analyst, every algorithm, every hedge fund that's already looked at Apple's earnings report, the price already accounts for what everyone knows. So if you're trying to find a stock that's undervalued, you're essentially competing against millions of other investors who have the same information, better technology, and more time than you. The market is incredibly hard to outsmart consistently. And the data backs this up hard. According to the S&P SPIVA report, which literally tracks this stuff, over a 15-year period, about 92% of actively managed large-cap funds underperform the S&P 500. 92%. These are professionals, with research teams, with Bloomberg terminals, and they still lose to the index. And here's the kicker. Some funds do beat it for a few years, but studies show that past performance basically doesn't predict future performance. A fund that crushes the market for 3 years is not statistically more likely to do it for 10. A lot of it is luck, and luck runs out. The S&P 500 wins largely because of math. It has insanely low fees, it's automatically diversified across 500 companies, and it benefits from the long-term growth of the entire economy. No single stock picker can consistently overcome all 3 of those advantages. So what does all this actually mean for you, a regular person trying to build wealth? Here's the practical takeaway. 1. Open a brokerage account. Robinhood or Fidelity are great free options. 2. Buy shares of an S&P 500 ETF like VOO. 3. Set up automatic contributions so you're buying consistently every month, no matter what the market is doing. And 4, the hardest one, don't touch it. That consistent buying every month is called dollar cost averaging. When the market drops, your $100 buys more shares. When it's up, you buy fewer. Over time, it smooths everything out and removes the temptation to try to time the market, which, as we just talked about, almost nobody can do successfully anyways. $200 a month, invested consistently in an S&P 500 index fund for 30 years at the historical average return. That turns into roughly $452,000. Not because you were smart, not because you picked the right stocks, just because you were consistent and patient. The S&P 500 isn't exciting. It's not going to make you rich overnight, but it is one of the most proven, battle-tested wealth-building tools ever created. And most people either don't know about it or overcomplicate it. If this video helped you understand something you didn't before, that's exactly what making sense of it is about. Subscribe so you don't miss next week's video, and I'll catch you then.